here's what I'm thinking. Some of the viewers might be like, oh my God, these loans are back. These are the loans that got us in trouble. Are they just giving out loans to anybody with a pulse again? So how do these loans now vary from what was available back in the day? Hi, everybody. This is Joseluiz Morales. Welcome back to the Morales Group Show. This is episode number 57. Today we have Cameron Frederickson here with us today. He is a loan officer here in Southern California. So Cameron is going to be educating us today on some creative financing strategies. He's going to be talking to us about bridge loans. He's going to be talking to us about stated income / bank statement loans. And then he's also going to be talking to us about DSCRs. Before we get into the show, I want to ask anybody who's viewing this, please subscribe to the channel if you haven't so far. Hit the like button. It helps the YouTube algorithm. And feel free to share it as well, too. So welcome to the show, Cameron. How are you?
I'm doing well, man. I'm doing well. How are you doing?
Good, man. So I'm excited about today's topic because I feel that what you are going to be sharing with us today, not a lot of people know about it, and not your traditional, and these aren't products that your traditional loan officer oftentimes can't do. And I feel that they serve a very specific need for very specific buyers. And I think that as long as they know about it, they can capitalize on using these types of products. So the first one I wanted to get into is a bridge loan. So what is a bridge loan and who can it benefit, and under what circumstances would somebody need to use a bridge loan?
So a bridge loan is a really, really awesome product for somebody that has lived in their home for a while and is ready to move into a new home. You know, maybe they don't have a lot of liquid cash on them for a new down payment. So what we can do is take equity out of their existing home and then put that as a down payment onto a new home. The really nice part about this is when you put that offer in, it's a non-contingent offer. Super, super important, I believe, in today's market where everything's just flying off of the shelves. You know, your houses are going up for 1 or 2 days before you know before they're already pending. So these are really, really good programs. A really good program for established people that have been established in their homes, have a lot of equity. And so let's say you own a $500,000 home, you owe about $100,000 left on it. You know, you can pull up to 75% of the home's value in cash for a new down payment. And it's awesome. And the great part about it is when you're doing this is it's done all together. So we're refinancing your old property, and then we're establishing that new loan over here. So it's done concurrently. So everything closes at the same time. So everyone gets their money, it all gets settled out. And you're not making any payments on that old house either. It's just accruing interest for up to 12 months, usually at about a 6% rate. And there's a balloon payment at the end of the 12 months, but I don't think you should have a real hard problem selling your house in less than 12 months in this market right now.
Absolutely. So essentially, if I'm hearing you correctly, it's basically like a refinance on your current home and basically a new loan, but they're both happening at the same time. Because sometimes what I see is that somebody wants to do something like that, but they refinance their property first, they get the money, and then they go out and make a non-contingent offer on the next property. But then they have potentially 2 mortgages as well, too, essentially, because they've got the refinance mortgage and they also have the new mortgage that they're going to be getting. So this is almost like at the same time, right?
Yeah, so these will be done at the same time. And the nice part is we're not going to count that old mortgage in your debt to income ratios. So you don't have to worry about this 6% accruing over here, because now it's all about the new mortgage. We only care about your ability to make payments on the new mortgage. So it's really, really, really great. It's a really awesome product. It's it's generally aimed towards your borrowers with higher FICOs. So if you have buyers with really good FICOs, we're talking like 740 and up, then this is the product for them, especially if they want to be able to place a non-contingent offer without kind of coming out of pocket with a lot of cash.
So essentially what Cameron is saying is for those buyers out there that are selling and buying at the same time, in today's competitive environment where there's 10 offers if you're competing against offers that are non-contingent, it might be really difficult for you to get your offer accepted. And this might be a product where you can make your offer non-contingent, get your offer accepted, and then focus on selling your property. Let me ask you this. Could you get your offer accepted and put your property immediately on the marketplace, or do you have to wait until that new loan closes?
No, so they're done at the same time. So the only way for this loan to work is by the time we're getting you pre-qualified for this loan, your house is going to be on the market already.
Oh, it is.
So we already on the market, and the wheels rolling on that. Yeah.
So essentially, you already have your property on the market. Does it have to be in escrow, or no? Just being on the market, essentially.
Just on the market. Yeah, there doesn't have to be any like pending offers or anything like that. It just needs to be on the market, and that's all you really need to qualify for that.
And then what would be the time frame like for like this? Because I'm imagining you're going through a couple of things. You're doing a refinance and you're getting a new loan. Does this process take longer than your traditional loan, or is it pretty much like the same process essentially?
No, it's going to be your standard 30-day close, maybe a little bit faster. What's really awesome about these non-traditional mortgage lenders is they tend to move a lot faster, because there's a lot more incentive for them to do this, because they don't have the same volume that your your conventional lenders will have, or your FHA lenders will have. They don't have that same volume, so they get things done a lot faster.
Okay. And then I know that we went over the loan on the property, the 6% interest only that's accruing over time, and you have 12 months to sell it. What about on the purchase side? Is that very similar to your traditional loan, or is that like 0.25 higher, half a point higher, a point higher, or what does that look like?
So your new loan is going to be just your standard full documented loan. So we're going to get all of your income. It's going to be at a pretty standard rate. Probably, if you want to save on points and fees and stuff like that, just take their par rate, which is usually, I think right now is about a 3.75, which is a really good rate. And yeah, and then that's what you're qualifying for. You're qualifying for that brand new rate, and that's about it.
So on the front end, it's just a traditional loan. On the back end, that's really where the uniqueness is coming in, where you're refinancing that temporarily to get some of that equity out. Now, you said 75%. You're able to borrow up to 75%, just so that our viewers understand. When we go back to that example, you owe $100,000. Property's worth $500,000. Let's pretend there's no fees associated with that. That means 75% of that would be of 500 would be 375.
375.
So essentially, the difference between the 100 and the 375 would be what you can take out and put on the next property. So essentially, this product is for people that have equity in the property. Basically, you have to have enough equity to be able to put down on the next property. Essentially, in other words,
yes. But I mean, yeah. So I mean, even that 500,000, that rounds out to $275,000 you can put down as a down payment, and that's a pretty competitive offer, I would say.
Extremely.
If you're,
extremely competitive. Okay. Now on the other loan, are there any prepayment penalties if you sell it like right away or anything like that? Or can you sell it like within a month, 2 weeks right after the refinance?
Once the refinance is complete, the sooner you sell it, the happier everyone's going to be. You're going to get more cash from the selling of your property. So the buyer's going to be happy. The buyer and the seller is going to be happy. Agent's going to be happy because they just sold the house really quick. And
it's a win-win.
I guess the only one that's kind of bummed out is the lender, because they're not getting that interest.
For a long period of time, is essentially. Okay. That works out. Good. So let's get into the stated income / bank statement loans. What is that, and who does it benefit?
So bank statement loans, we aim these mostly at like our fellow 1099 employees, our self-employed people, our small business owners. These are the people that are going to really benefit from these 3 to 12 to 24 month bank statement programs. So basically, we will take X amount of months of bank statements, plug it into a calculator, and figure out what their actual income is. Because I know you've done your taxes, I've done my taxes. What we've actually made is not actually reflected in what our taxes look like from year to year, because there's a lot of deductions, there's a lot of depreciation and stuff like that, and that it happens all the time. I'm seeing with a lot of these self-employed borrowers, and these 12-month bank statement programs are really competitive with what's out there on the market for conventional loans right now. The rate's going to be a little bit higher, but it's a really great product for these people that can't get a traditional conventional mortgage.
So what Cameron is saying is that sometimes business owners have a little bit of a harder time qualifying because of all the deductions. Essentially, they want to write off as much as they possibly can, which brings down the income. But then when it comes time to qualify, essentially they're in a position where they wrote off too much. Now they don't qualify for a mortgage loan. So essentially this product benefits. Now, how does the product work? I know that you said that they take anywhere from 3 months, 12 months, 24 months of bank statements. How does that look like? And how do you determine how many months you actually need? Or is it just the months that show the most amount of income?
So let's use the 12-month example. So we're gonna take the last 12 months of all of your income from your bank statements. We're gonna average it out. And let's say you're a real estate agent, right? And your biggest expenses are gonna be stuff like maybe gas or advertising, that kind of stuff. So the lender's gonna take that, figure out your profit, subtract out your costs, and then give you a running average of what your income looks like. And it's a small haircut. And then that's how they're going to come up with this income for you, basically.
Yeah.
And so the nice part about it is a lot of these programs, it's dependent upon your FICO, but if you have a really good FICO score, your down payment can be as low as 10%, and you're going to close in less than 30 days. If you got a lower FICO, you can still put 20% down. The scores go all the way down to 600, which conventional loans don't even do. So it's a really, really expansive program for every self-employed borrower out there, business owners, stuff like that.
And do you get to choose which statements you actually show the lender, or is it pretty much all your statements for every single account, even if you have separate businesses, or is it just for that specific business, or how does that part work?
So if I have one business, I'm gonna show the 12 months of deposits and all that in my business account. If I have two businesses, I can submit both of those, both sets, and it's really, really flexible in that way. You can also use personal accounts. So if you migrate, if your money ends up in your business account and then you move it over into a personal account, then you can also do that.
Use personal.
Yeah,
okay.
It's
and then
really
you said that they're pretty comparable in terms of interest rates, or is the interest rate a little bit higher, just a little slightly higher, essentially, is what I'm hearing, right?
Yeah, it's going to be a little bit higher. The last time I priced it out, the par rate on it was about a 4.25,
which is still excellent.
But yeah, it's an excellent rate. But you can also buy down the rate as well at very competitive prices too.
And are these rates fixed rates, or are they interest only? Are they variable? And how long can you get them fixed for? 15, 20, 30 years?
Yes. So you can do interest only, you can do your ARM, you can do your fixed. One of the lenders we work with has a 40-year interest only, so and it's a fixed, so you can get 10 years of interest only at a 4.25, and you're paying only interest for those first 10 years, and then on the back end you have a 30-year fixed that's going to amortize, so you're going to actually build equity into the house, and that's killer. Like, I don't know how long you can, like, if in 30 years you're going to be able to say that I have a 4.25, you know, because who knows where this market's going right now. And, you know, with rates going up, getting into a 30-year fixed at 4.25 it's a great deal.
Yeah.
Especially for these borrowers,
Absolutely.
buyers.
Now, is a bank statement loan the same thing as a stated income loan, or does that vary at all?
Yeah, I think that's what we would call a stated income loan today, is basically this bank statement program.
Here's what I'm thinking. Some of the viewers might be like, oh my God, these loans are back. These are the loans that got us in trouble. Are they just giving out loans to anybody with a pulse again? So how do these loans now vary from what was available back in the day?
Well, so pre-housing crisis,
Uh-huh.
lenders were just handing out loans to everybody and everybody. Didn't care about your FICO. They didn't care about how much money you made. They didn't care about any of this stuff.
Yeah.
And it was all equity based. So if you were to foreclose on your house, they didn't really care. You know, they were like, oh, we'll just sell it and, you know, get all our money back at a profit. And now that's not what's going on now. That's why we do go through this like 12 months of bank statements. They want to make sure that that your income is consistent over those 12 months. That's another thing they're looking for. So if they see like, you know, your income is slowly declining over the 12 months, you know, you might not get approved. So it's something to be on the lookout.
Yeah.
But definitely nothing like what was out there in 2008.
Yeah, before they would just take your pulse, and if you had a pulse, essentially they would say that was your pre-approval, and sometimes it wasn't. You know, there didn't even have to be a pulse. I wasn't in the business back then, but that's what I hear. So what I was going to ask you is, are these types of loan products only for residential? Are they for commercial? Are they for condos and townhomes? Are they for manufactured homes, or just residential products?
The nice part about working with non-traditional lenders is there's a lot more flexibility in the lending practices. So you're going to be able to get these condos, townhomes, residential. Commercial is a whole different beast. But and then manufactured, they tend to be a little more picky about. Yeah. But as long as it's in good shape, hasn't been moved too many times, and I'm sure it also meets traditional guidelines, they would approve that as well.
Awesome. So the last thing is, let's talk about DSCR loans. What is a DSCR loan, and am I saying it right? And who does it benefit?
So it's a DSCR program. So DSCR stands for Debt Service Coverage Ratio. Now these loans are going to be really good for your investors. These are guys that want to buy a rental property, maybe even people just getting into the real estate investment side of things. So what you're going to see typically with these is they're going to want a little bit of a higher FICO. I've seen places go as low as like a 760 or so. You're looking at least 20% down. You're going to want to have, they're going to require you to have 6 months of reserves. And then so once you get that all done, you're going to do based on the property, they're going to do a rental appraisal. And so they're going to send an appraiser to see what the current market rate is for that particular property. And as long as the estimated rent coming in for that property is higher than the mortgage monthly payment, you would qualify for that. So we don't need income, we don't need a job, we just need 6 months of reserves and a down payment.
So no income, no job. The main qualification is basically, does the property produce enough income to cover the debt and all the other expenses on the property? That sounds like a great product, essentially. Okay.
It's a really, really cool product. Is there anything else? If the rental income matches the mortgage payment, you would also qualify. If your FICO is up there, If you have a really good FICO and a good down payment, sometimes they'll even do 0.75 of the mortgage amount. So if the rental income is $1,200, but the mortgage payment is $15, they'll still approve it, which is really, really cool.
Now, are these purchase only, or like, let's say you have 20% equity in there, can you refinance and get money out at a 80% LTV or even a 75% LTV?
Yeah, you can refinance your home into this program. So if you want to pull cash out, like let's say, you don't want to, like a bridge loan scenario, maybe they don't want to sell their home, they want to keep it as an investment property. A DSCR product would be great. They could take out as much cash as they needed, up to 80%, put that as a down payment. Once that sorry, once that loan has closed, and go out and make an offer on a new property.
So what I'm thinking that this product is, a lot of times where people struggle getting loans is once they're retired, or once they're retired, a lot of times they don't have the steady income that they used to have back in the day. And some people have tons of assets, but they don't have that steady income as a normal job. And sometimes for those types of individuals, it makes it a little bit harder for them to qualify. So I'm thinking as long as they have a property that is producing sufficient income, then this could be a product where they can either pull money out or basically purchase a property with 20% down. Now, these types of loans, how are the rates? How long are they financed for? And what are the fees like? Are they traditional? Can you educate us on that a little bit?
Yeah. So it's going to be you're also going to have an interest only on this. So if you're an investor, you can really maximize that cash flow. You can do that, that same 40-year fixed rate on there. The rates are going to be a little bit higher, 5% and above, probably no higher than 7%. You can do a 5 or a 7-year arm on there. I know one lender has a 30-year with a 7-year interest only and a 23 fixed, but that 7 years is on an arm, so that'll adjust every year. And then this is a really, really good, great product for those who are who want to invest in. If you really want to maximize your cash flow, this is the way to do it.
Yeah, because it's interest only. You don't have to pay down the principal essentially. So exactly. I'm thinking some of these products, some people are doing ADUs right now. They're doing an accessory dwelling unit, and essentially that adds a lot more income to the property. So you convert the garage, that adds an extra $1,450, $1,500 a month. You convert a junior ADU. Now you've added all this extra income. Now one of these products could potentially be good for you guys. Good. Is there anything that we missed or anything else that you think would be of value to the viewers?
Yeah, I think we covered a lot of really good stuff. I think for anybody listening, potential buyers or real estate agents, just because your taxes are low doesn't mean you're not going to qualify. I believe that there is a loan product out there for everybody. You just have to look, and you have to try, and you have to kind of hit your head against the wall and figure it out. Yeah, but there's always going to be, more times than not, a loan out there for anybody and everybody looking for a loan, as long as you've got the down payment and loan out there for everybody. If
you make good relationships with a loan officer, they can be your best friend, man, because essentially, like, you've got your traditional loan officers, hard money, you've got creative financing. Like you said, there's a loan product out there for everybody. And essentially, just because Bank of America, sorry, nothing bad against Bank of America, but just because they denied you because you're self-employed, that doesn't mean that there's not a product out there. Just because another bank denied you because you don't have any income, that doesn't mean that there's not another product out there. It's just about being connected to the right people and getting the information from the person that may have that different loan product that could potentially help you. That's one of the things that I learned, Cameron, early on in my career. And I learned it hard way because I had a client that got rejected for a loan by one lender, took him to another lender. the other lender said, yes, we can do the loan, no problem. And at that point, I was like what's going on? You know, that buyer potentially, some buyers might have quit already, might have said, I don't qualify. I was told I don't qualify. That buyer, we got him a second opinion with a different loan officer, got their house, and essentially there was a loan product out there. So essentially, just because you've been said no by somebody, that doesn't mean there's not a loan product out there for you. You just have to be connected to the right people. So Cameron, where can people get a hold of you if they saw value in today's show and maybe they want to get in touch with you?
Yeah, so you can reach me on my cell phone at 661-350-5872, or via email at Cameron, Cameron at vplending.com. And then you can also look up the Van Patten Mortgage Group on the internet. We have a really nice template in there for people that are just kind of looking to see what they can pre-qualify for. We'll usually get back to you within 24 hours and kind of talk about your loan options. So, yeah.
So the last thing, Cameron, I'm not going to be shy. I'm going to ask people to subscribe again. If you haven't subscribed, if you haven't hit that like button, it helps the YouTube algorithm. It helps spread our message to a lot more people out there. Once again, this was episode number 57 of the Morales Group Show. This was Cameron Frederickson with VP Lending, and he basically educated us on bridge loans, bank statement loans, DSCRs. Thank you so much, guys, and stay tuned for the next one.
Have a good one, guys.